Patrick, good morning. How are you?
Good morning, sir.
Hey, welcome and happy Friday and happy jobs report day.
Yay.
Hey, yay! Hey, I know you're I've never had a chance to talk with you, but you are the bad charts guy. So that means you probably want to talk charts. Let's see what you got. Tell us a little bit about yourself, and I'm gonna go ahead and stop sharing the screen. And why don't you bring up some of the charts that you want to talk about, and let's discuss kind of your background and what your thoughts are following the jobs report here.
All right, let's do it. Well, yes, of course, it's like everything is chart defined. Like from a chart trader's world, we accept that we don't know everything, right? And even somebody who does fundamentals and analyzes individual uncharted metrics, they you have to accept it's kind of weird because people this the job report it has to move in this direction, uh, the US dollar, but that's because you're looking at it through the evidence that's presented to you, and you think that's what's moving it. But did you ever think that maybe there's an element that you don't know about? And how dangerous is that? Let's say whenever you go play a game, I go play poker there, and I just know some of the rules, but I don't know most of the rules or all of the rules. Isn't that like a dangerous proposition? And I see it all the time. People trading with their money, like it's they hear a tip, or they see this influencer do that, or there's this element there, and after that they start like placing bets on the markets. And it's just for me like the easiest thing is just take a step back. The chart is the aggregate of all known and unknown fundamentals, any metric that to me. So I don't need to worry about individual jobs report or stuff like that, unless if I was able to chart the unemployment rate, which I do often, right? It's like I call it chart defined macroeconomics. If I'm able to chart the Fed fund rate, if I'm able to chart that, then that's more valuable information than just expecting something based on a number. It's like, look, I show you because I was listening to you guys. I joined a little bit before there, and you're wondering is like the markets, should we buy this dip? Well, everything also is defined by time frame, right? You guys, I saw sometimes you're on the daily, on the weekly, but not all daily defined corrections or dips are built the same, right? If you're at the beginning of a monthly defined breakout, so let's say here, guys, on my screen, what I have is let me zoom out. Here, wait, back. On my screen here, I have the monthly chart of the SPX, all right? Above that blue line is the 12-month moving average, the red line, the 36-month moving average. And at the bottom pane is the distance from the 36-month moving average. So how far are we away from the 3-year moving average? And often, sometimes people say it's reversion to mean. You could, once you're stretched, a lot of the gas, the fuel that was used to explode the price off a big base and then to drive it up and away from that moving average, sometimes it runs out of steam, right? Whoever wanted to buy bought. There's not, and then people who bought lower, they're gonna want to sell, and then it just stalls the price until there's a reconnect with the moving average eventually, right? Look where we are here. Look at the SPX, how stretched it is from its 36-month moving average. It doesn't mean it's a top here, guys, by no means. But the low risk entry is when you're coiled and tight close to a moving average and breaking up away from it, then stretch. And these areas here, right now, I'm unless you have some type of melt up here where it keeps going up like we had in the 2000s. From a statistical perspective, I say I'm in the range now of FOMO, of profit taking, um, possible tops, possible now my daily defined corrections. If I have a correction starting on the daily chart, it has a higher probability right now of cascading on the weekly. And if the weekly, correction starts failing, then maybe this black line here, this rising trend line might fail. I might start losing momentum, right? If there's a break here with my distance from moving average failing to accelerate at the same rate, I'm in the start of a more important correction, right? And remember, all important market tops start with innocent looking corrections on the smaller time frames, but not all smaller time corrections are market tops, right? So you got to be careful. But when I see that, I would never enter here on this, even a shorter term correction here. You got to be extremely nimble to go along the SPX right here because you're in the fluff territory, right? And about these yields, if you don't mind me ranting a little bit more,
No,
this
please.
This is the I got here the 2-year yield, so it's very fine there. It's the candlestick chart, and I have the Fed fund rate here overlaid on top of it. And sometimes because I heard somebody say, the 2-year yield is moving upwards against the Fed fund rate. That means it's the market being smarter than the Fed, and they're probably going to stop cutting. And I said, "Oh, okay, let's look at the evidence, right? Because whenever you hear any anecdotal or any one-time piece of evidence as a chart trader, you got to look at the charts and see what actually is happening. So when I overlay the two, I say, okay, they're not tracking exactly the same. So maybe I'm not looking, instead of me trying to fit a narrative in here, I'll say, maybe I'm not looking at the metric or instrument that the Fed fund rate is actually tracking. So here below, I'm back at the 2-year yields. I put the 36-month moving average on the 36-week moving average on the 2-year yield. And then, hey, look at that smoothed out curve. And look at that. If I overlay the 36-week moving average of the 2-year yield overlaid with the Fed fund rate, now I got something better, something that tracks more. So the Fed fund rate, maybe the Fed's slow, maybe by the time they ingest their metrics, even if the market's like jittery and volatile on the 2-year yields and it's starting to look like it doesn't want to go down the 2-year yields and go up, the Fed looks that they track more the moving average of the 2-year yields. And look at that. For me, as long as the 2-year yield, the moving average of it, the 36-week moving average is trending downwards, not flattening, for me, the trajectory right now, the Fed's going to keep cutting and keep cutting and keep cutting until the flat line. I don't know which one's the chicken or the egg. Like, eventually,
So
maybe
you're in the camp that they will just continue to cut.
100%, 100%, 100%. If they're cutting, and look, I have the overlay recessions right here, the green overlays. These are recessions. And I asked ChatGPT, what are the official dates of the recessions overlaid versus when they actually happen, when they announce it, right? Man, they're usually 6 months to a year and a half late in announcing it, and for the start of a recession and the end of a recession. So you gotta, if like these green overlays were added like almost when the recession was actually ended. So it's kind of weird. Like if you're waiting for the National Bureau of Statistics or whoever, of labor to tell you when the recession is, it's like it's gonna be in hindsight, right? But when I see this, a Fed fund rate cutting like that, you gotta say, good, my goodness. And I'll show you here. Here's an exception here in the 90s, but I'll show you why this is more of a glitch than an actual. When they start cutting like that, you're we're in a recession. They're coming up shortly. Maybe I think the recession is actually going to start when the SPX starts faltering, like from that top chart I showed you. But we're really, really close. And look at this one here. Here I added here's the SPX reactions, right, on these recessions. Drop, 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 drop. Here, except here, when you see this Fed fund rate here went up and sideways. Look at this. Here I have the unemployment rate, that blue line here. So it's additional. It's called also the weight of evidence, right? You had more evidence. The unemployment rate had peaked and was unwinding. Practically nowhere here did you have a new uptrend, right? I could have drawn a trend line. It's very difficult to see a new uptrend and unemployment rate. So even if the rates were going up here, as long as the unemployment rate is peaking and downtrending, the markets are 100% safe. So as this was unwinding, look at that. We had the dot-com bubble, it was just beautiful, right? But every time the unemployment rate bottoms and moves up 25% off a bottom, recession, 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 recession here. And look at that. Look what's happening. It's trending upwards. Or like I have other charts where I show this. It's we're off 25% off a bottom here. So if you add the evidence with the Fed fund rates turning down, with the unemployment rate going up, with the yield curve, the 10 minus the 2s going up, goodness gracious. The only piece of the puzzle right now is missing is the actual SPX to drop, because that's the final piece, right? But in no
And so,
way.
I mean, yeah, and so tell me what you feel about, or how you feel about equities here. I mean, everybody's trying to call a top. Everybody thinks that the market's it's gonna come down, due to, for whatever multitude of reasons. What are
Yes.
your thoughts about the S&P?
You can't look. You can't call tops. You can't. How can I say this? You know how it is. Like people call tops, they're going to call 100 tops before they get the top, right? Only in
Right.
hindsight, we're ever going to know what the top is, right? But we can know is as chart traders is if we start failing. So let's say I'm going to bring up here. I'll bring up here's the SPX. Here, look here. Even is SPX priced in gold. Distance from the 36 quarter moving average here at the bottom. It's priced in gold. The SPX has already lost a rising trend line. But I'll just go the SPX because people they don't care about gold. So here, quarterly chart stretched, but there's no breakdown, right? There's no you can't say there's any type of breakdown here. There's nothing here. So what you do is you zoom in, right? Until you find a time frame where it is starting to fail. Here, there's like even this, it's still an uptrend. I'll go on the weekly. Let's move that green line. I'll put it black. Nothing against green, but let's put that line black. Still an uptrend, still above its 36-week moving average. Nothing here. So let's say on the daily, I have a feeling the daily is starting to roll over a little bit. So it's, oh my goodness, getting close. So look at that. Ah, man. So that's, it all, like I said, it always starts on the smaller time frames, right? So if the daily is looking like that, I'm pretty sure all the other time frames under the daily have rolled over. 1, 2. This is a valid rising trend line, right? 3 points. This is the thing. Before you go in a downtrend, you go neutral. So that's a trend that's going up above an inclining 36-day moving average or whatever it is. That's an uptrend. Before it goes down, it has to go neutral. It has to start putting price points around the moving average to flatten out, right? So that makes it vulnerable. So that's what's been happening for a while now. We're below a moving average. It's not trending upwards. So now what I say is from a statistician point of view, I say, okay, we're increasing the risk now. I can't be bullish anymore. Anybody wants to be on this time frame, of course. For me now, what I do is I draw lines in the sand. If I see what the chart is morphing into. So if I'm below that line here, and I'll put a horizontal one, probably here. So as long as I'm below 6,044, you're in a congestion area. Here's a more meaningful resistance level, support level. Man, you're no man's land right now. So you step aside. You don't buy a dip. There's no breakout here. You don't buy dips. You buy the breakout following a dip on a bounce of a support, right? Because you don't know you don't know if this is going to cascade into a 2001 top, right? A 2007 or 8 top. You don't know if this is going to be a top, right? Only in hindsight we're going to know. But you can see because of this, you see all these, that's what I was showing you, all these flags there, whatever you have along the way, right? Those moving averages, the distance from the longer term moving average, I'm going to put back where was I? My SPX chart. Here, I'll put, in this run up here, there was a whole bunch of daily chart pull flags, right? Because any uptrend, the basic components is pull, flag, right? And the flag usually it resolves upwards in a bull market, and the flag usually fails at the top, and then after that you have bearish, right? Bearish flags. As you move up this ladder here on the longer time frame, each of these smaller term pull flags, these corrections on the daily chart, have less and less chance of resolving upwards. So right now the odds are that there's increased odds that this flag here or whatever, this pull, this flag congestion area here, the odds of it resolving upwards right now are much less than they were here. They're much less than they were here, right? They're much, much less than they were down here, right? It's just because you're stretched on a higher time frame, that long-term buying power is just evaporates over time, right? It needs a reset, right? It needs a so this right now, people when they just look at one time frame, they make the mistake of not looking at the higher time frame, and they say, okay, well, it's going to resolve upwards. Well, hold on, you don't know where you're going to be. It could be here at the 2000. You could be here. You could be at the top like you were back in the 2000s, right? If I go here to 2000s, you know what I'm going to do for you? I'm going to put here. I'm going to put what's 365 times 3? It's going to be 1,000 about. Here, I'll put the distance from the 3-year moving average about here. So you see all these pull flags we had here in that 1995 run. As long as you're coiled and tight closer to the long-term moving average, they have a higher chance of success, right? But as soon as you get really stretched and you're starting to lose, doesn't mean the price can't go up anymore, but you're starting to lose upwards momentum. And then after that, when you start to really lose an important top here, look at that here, bam, you fall. So right
Right.
where we are today, we're up here. So as long as this, the longer term rising trend line does not fail, you're good, but the higher up you are that ladder, the less probabilities are that it will continue upwards, right? It's just not the low risk entry. You could look at Microsoft, you could look at Nvidia. Oh goodness, Nvidia, my goodness, look at that. That is one chart look at that. This at the bottom is the distance from its 3-year moving average. Look at this. When you had these important toppings, top here, look how stretched it is. I'll put a horizontal line for your viewing pleasure. Look, up, you don't know how long it could keep going up after it starts talking. But once it starts rolling over, I'll put some vertical lines for there's not much left. Like even sometimes people, oh Patrick, you, it kept going up. Yeah, sure. I don't mind if it keeps going up. I didn't lose any money because it kept going up, right? I'll lose money if I hang on while that thing's going down. But you tell me when you see that visually, where are the lowest entries? It's like low risk entries are coiled and tight, exploding upwards. Coiled and tight, exploding upwards. This one, look at that. Often the momentum will fail. So the momentum, I define it as distance from a moving average. The momentum will fail before the price fails because you're losing. You're on the highway. You're running out of gas. You can't accelerate as fast. You're redlining. And oh man, look at that. I'm going to put on the line chart just to make sure. So it's losing, rising. Like, the more steep an angle trend line is, there's still energy going upwards, right? So you got to wait. Eventually, it could be, a trend line here. Eventually, there'll be maybe a flat one. The flat ones, of course, are the more important trend lines. But you're just, it's just crazy, man. We're just not at a low risk entry. And they're even from a classical TA, you have a whole bunch of measured moves. I also do that exercise. I always look, okay, well, let's see. Sure, distance, but look, pull flag, measured move reach, target reach. Like, what are you expecting here? You're expecting rocket ships nonstop. Eventually, you need another flag to build out, right? You need more momentum to reset. Once these targets are reached, that's it, right? It's like this is just nonsense right now. This is a time to um, US dollar or whatever. The US dollar is doing great. I was linked to you guys, and I just want to share something. If you want to know for me what drives more, let's say the US dollar. So here, guys, this one here is the CAD USD, and this here is the Canadian rates minus the Fed fund rates. But you could do this because I did this really fast there while listening to you guys. You could do the U.S. 10-year yields or the Canadian 10-year yields minus the U.S. 10-year yields. Any yields on the curve. It doesn't track perfectly, but for me, what drives a currency pair more is the delta. Is there more incentive for somebody to hold Canadian dollars or US dollars? And primarily, if I would ask just anybody, well, I'm going to look at the interest rates that they pay in the bank, right? So I don't know if look at that. Look at the delta. So as long it's not that the US rates could go up or down, it's how much more or less are they paying you than what Canada's paying you. I did it also for Japan real fast. Here's Japan. Okay, here, this is the yen. This is the Japanese USD pair. I know usually we see the inverse, and this is the Japanese rates minus the Fed fund rates. It's not perfect. It's like, that means there's more stuff interfering in it. But look, as long as it's trending in the same direction, you gotta anticipate, unless maybe this was the bottom, it goes up. You have additional evidence that it's still more favorable to hold US dollars than the yen. So you gotta expect that the yen's going to it's going to keep falling versus the US dollar. But again, whenever there's doubt, guys, I'm a chart trader. So that peripheral evidence is fun, but you don't trade the peripheral evidence. You trade the actual chart, right? So you got to look at the actual chart. Is it stretched from moving averages? Has it reached measured moves? You got to look at stuff like that, right? But the DXY is looking to go here. The DXY for me is like, it looks like it has a a destiny of 120, right? Who would have thought? Look at that.
Yeah.
It's like that thing's heading to 120. And guess what we had at 120? That was the peak. That was the dot-com bubble peak. And there's often another peripheral evidence or weight of evidence. I overlaid here the SPX. I'll overlay also, let's say recessions. Put recession indicator on top. The US dollar is like, I see it like a wrecking ball. And depending when it flares up, and if it flares up and the US equities are stretched and having a hard time, see here, the US dollar just going bonkers. Look at that. That was a dot-com bubble. Like just that melt up here out of this rising breakout line, very aggressive. The move downwards, right? So I'm wondering, I don't know, like again, you can't trade these analog things, but makes you think that if the US dollar is going to run up here, if ever and whenever the SPX actually does lose a rising trend line, that's probably when the US dollar is going to start to unwind, right? They're going to drop rates more than the Eurozone, more than Japan, probably to save the US equities, save the labor market, whatever reason they're going to do. And it's going to help put a floor under the markets. But look, it's crazy, man. There's so many moving parts in all of this. You gotta, if ever, like for a newbie or anybody who's like, okay, this is too much stuff, then go back to the basics, look at the chart, pop up distance from the 36-month moving average. If it looks like that, just don't. Who cares what Michael Saylor says or who, like, you just step aside, you wait, and you wait until, like, it's, we have like when you play poker, you're, of course, there's blinds and sometimes there's antes, but you could wait for your hand. And as a
Yeah.
trader, you could wait for that your hand also. You don't need to to always have your hand in the cookie jar, always playing every single pot. You could wait, and the more charts you look at, the easier it is to wait. Because let's say Nvidia is not ready, and well, there's other sectors, right? When the tech stocks are topping and going down, what's happening? Well, there's energy, right? Let's say I put a range resources there. Look at that. Range resources, like distance from moving average. Did you buy here? No. Even here, even if the price went up here, buying here is not a low risk proposition. But look now, coiled and tight, close to the 3-year moving average. As soon as the momentum maybe starts breaking out of more important, less slanted rising trend lines, then you got fuel, right? The distance here in moving average, the explosiveness, the reservoir of explosiveness before FOMO catches on, before your hairdresser tells you that he made a bunch of money in oil plays. Well, it's happening here, and that's kind of like kind of a look at that a false breakdown, a bearish rising wedge, false breakdown through the apex move. If that thing closes above that black line, it's going to be a crazy move out of this thing, crazy, and especially because of the setup. So people don't like oil. I know there's a recession, like all that risk, but sometimes you often seen oil flare up in the first half of a recession, and then when everybody says,
It
okay,
creates the recession.
yes,
It's usually
exactly.
the
It's like
higher
the
prices
last,
that does it.
here, I think I have it here, there. I did it for, okay, I have to go on the smaller time frames there, but if you overlay the recession charts and oil, okay, not the 2008 one, but look at that here. Look at that. Oh, yes, the 2008 one. Look at that. Huge flare up during the recession. Huge. It's like, and I think even 2000, not 2001 did not do it. Flared up a little bit before, but you see it bottomed not at the beginning of a recession, right? Like much later.
Yeah. Well, Patrick,
Yeah.
I have to cut us off there just because I have to host the Morning Edge show. But let traders know best way to follow your work.
Sure. Bad Charts One on X or Twitter, and I have a paid membership website with my friend Kevin Wadsworth, NorthstarBadCharts.com. You could get all these in-depth review and analysis there on that website.
All right, Patrick. Well, thanks for joining us. Happy Friday, and thanks for joining us on this non-farm payroll day.
Thank you, sir. Take care.
All right, and guys and gals, like I said, we'll be full. Well, actually, Dale will be back on Monday, and he'll be happy to be back, I'm sure. And K-Man will be back on the Flow Show, and we'll have a full team here next week. So, good luck. Thanks for hanging out with me today, and happy Friday to everybody. All right, bye-bye. Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.